Hello everyone, welcome back to another Lunch and Learn webinar series. I am Mayur Thaker. I am an analyst and co-portfolio manager of the Zacks Earnings Certain family of portfolios. And today we're going to be talking about a subject that I think everybody should be going through when assessing the companies that you own in your portfolio. And that is how to QC your stocks. QC meaning quality check. So in this presentation, we're going to talk about a couple of practical exercises that you can run through to assess the earnings quality of any company, but especially the companies that you own in your portfolio. So let's get started. So let's first define what quality is, and this is something that I talk about quite often when talking about the Zacks Earnings Certain Portfolio. What is quality? And again, regardless of whether you are a growth investor or value investor, we should first be asking, is this a quality company or not? And what quality means is we want to find companies that have, delivered consistent results, that can consistently deliver high performance to, their clients, their customers, and ultimately to shareholders. And then, we want companies that have high durability, so the ability to repeat that, into the future. And that's really it, these two criteria. So we can define each of these two. Number one is consistency, right? So we want companies that have delivered consistent earnings per share growth, companies that are able to translate that earnings per share into free cash flow per share. This is very important because a lot of companies can show good earnings, but they don't show great free cash flow, and that is a red flag. So that is one, step to, quality check, quality control. And then thirdly, we want companies that have consistently attractive returns on invested capital. For this presentation, we won't talk about this number three, as much. I have other presentations on this channel that you can look to get a more in-depth analysis of how ROIC works. But we're going to talk about, especially number two in this presentation. But overall, these three factors combined, it tells you the business's past financial performance and management's ability to allocate capital in the past. And sensitivity to past economic cycles. So the key word here is in the past. So durability helps us understand the future. So we use everything that we've seen in the past with regards to their consistency in earnings per share growth, even through recessions, their ability to translate that to free cash flow, and then high ROIC. We use those pieces of the past and now assess the durability of the company to see how that can continue into the future. So for that, we look for things like needs over wants. Does the company supply a critical need over a want or a desire? Do they solve a pain point, or do they cut costs? Do they increase utility? These are all things that can lend a hand into durability. Also, this is huge. Do they have high recurring revenue? So that can be in the form of subscription revenue or contract revenue. Lease revenue is another one. Do they have high client retention? That can come from brand value, that can come from product experience, that can come from great customer service. So these are all questions that you should ask, and they should be checking off at least one or two or several of all of these items that I mentioned. And then strong capital allocation, which means, are they reinvesting in themselves? This is a great forward-looking indicator as to whether they can continue the growth into the future or not. Are they reinvesting cash flows back into themselves? Are they retaining earnings to reinvest in themselves? Because if they're not, then that could mean that the best days are behind them, and now they're going from a growth company to a return of capital company. So we want to be in the former. We want companies that are growing and compounding earnings. So combined, these factors tells you about the business's ability to continue high performance into the future. So let's talk about the four ratios, and this is where things get, kind of, pedal to the metal. The tire hits the road here, where what can you do, practically speaking, to assess the quality of companies that you own in your portfolio? So the first item that I'd like to look at is operating cash flow to net income, the ratio of the two. And this should be above 1 in most periods. So the average ratio of operating cash flow to net income, say over a year or over 2 years or over 3 years, there's no, magical number, but overall, this number should be above 1. It may fall below 1 for a quarter or two. That's fine. That's understandable. But that should not be persistently below 1, I should say. When this ratio falls below 1 persistently for a year, for 2 years, for 3 years, there become significant quality concerns. Because remember, what is operating cash flow, right? It starts with GAAP net income, and then it makes a number of add backs. It adds back stock-based compensation. It adds back, depreciation and amortization expense. It adds back certain non-cash expenses, like amortization of goodwill or, asset impairment charges or, inventory write-downs. These are all expenses that hit net income, but they're non-cash in nature, so they get added back. And then you have working capital changes as well. So if there's an inventory build that's negative on operating cash flow, if there is an increase in accounts receivable, that's also negative on operating cash flow. So overall, operating cash flow should be greater than net income. Why is that? And that's because if operating cash flow is less than net income, that means that there are too many cash expenses that the company didn't record, on the P&L. So, for example, let's say a company had, phenomenal net income growth of, let's just say, 20%. That's great, right? Most people would celebrate that as great growth. But what if, a substantial amount of that net income was booked into accounts receivable? So that means that technically they sold a lot additional product, but they didn't actually collect that as cash. It went straight onto the balance sheet as a receivable. And so that's a promise that whoever you sold to will pay you in the future, but they haven't paid you yet. So that can happen for a quarter or two. That's fine. We businesses are complex, creatures. So, they may have sold to a single or a couple of customers who will pay, you in arrears. So that, goes into receivables. So that might be collected in the next quarter or two. So that's fine. No big deal. But that's why I believe that you should look at this number over multiple years. And if this number is below 1, persistently for more than a year, then that starts to call into question the quality of that net income. Remember, Enron was, notorious for showing great net income growth, but they never could produce a coherent cash flow statement. I believe there was actually a point on one of their earnings calls where an analyst asked about, operating cash flow, and, the CEO just laughed it off, and was essentially extremely arrogant about that question. And it's because they couldn't actually show that net income was actually being collected as cash. So anyone who is laser focused on this number will get ahead of significant earnings deterioration. And we'll look at a few examples of this in just a few minutes here. So this number is very, very important. And actually, if you even the CFA curriculum, mentions this as a principle. Remember, the CFA curriculum, if you've been through it, they don't usually talk too much about, hard numbers or hard rules. The CFA curriculum is mostly about concepts that are timeless in nature. And yet even they, mention that, this ratio, when it falls below 1 persistently, you really have to put on your analyst hat at that point. And you should be able to explain that in a way that is understandable. And if you can't, then that is a significant concern. So companies that are below 1 persistently, unless if you can have a very good reason for why that is, I would start to put that on the selling block, because there's too many examples of companies that have had precipitous drops in the stock price when this number gave you a very fair warning well in advance. And we'll take a look at 2 examples of that in just a few minutes here. Now, this number is related. It's less important, I would say, than the first one, but still very important. Free cash flow to net income. The highest quality companies score above 80% on this number persistently over time. Again, there may be a quarter or two where it's below 80%. It could be 70%, could be 60%. But on average, over, say, a 3 to 5 year period, the best quality companies like Visa or MSCI or others like that, they score above 80% quite consistently. So if there is a company that's persistently below 50%, that should start to raise concerns. So free cash flow to net income really should not be below 50% persistently. Now, I would say that this number is less hard-coded than this number. You can have a situation in certain cases where free cash flow does fall below 50% for a while, and that's not necessarily a doom and gloom scenario. But I would say that, if there's something below 50%, that should be a company that you place under review, especially if there are other companies that are above 80% that you don't own. That would be a great place to sort of, reallocate your portfolio into companies that do have very high free cash flow to net income ratio. This ratio is also called free cash flow conversion, by the way. What percentage of net income is the company actually translating into free cash flow? So the ideal is above 80% over, say, a 3 to 5 year average. But if this number is, falling below 50% for more than a year, I would start to place that on the chopping block in favor of other companies that, are, satisfy quality criteria in all other areas and give us 80% or greater free cash flow conversion. Another item that's also very important to look at, GAAP net income as a percentage of adjusted net income. One-time items should be truly rare, because remember, what's the difference between GAAP and adjusted net income or earnings? And that is the one-time items. So remember, what is GAAP? GAAP is revenue minus all expenses, regardless of the nature of those expenses. And what is adjusted? Well, it takes GAAP net income and it adds back certain one-time items. So let's say a company just had to fend off a major lawsuit, so they had a big jump in litigation expense, and let's say that lawsuit was settled, so they had to pay a big fine or something like that. That would be truly one time, so that will roll off the P&L in future quarters. But if a company consistently has these quote-unquote one-time items, then are they really one-time in nature, right? So if the company always has, an asset write-down, for example, an asset write-down would be considered one-time in nature, and it would get added back into the adjusted number. But what if they always have these asset write-downs? What if they always have inventory write-downs? What if they always have, for some reason, litigation expense? What if they always have, or what if it's a rotation from one to another? In that case, again, if there are persistently large differences between GAAP and adjusted net income, then that should start to raise concerns. So again, over time, the average should be close to 1 between the two. So there really should be no difference. In practical matters, there will always be differences as long as they have, at least one case where they had a one-time item. But the number should be stable and close to 1 over time. Maybe it'll be 90% or 95%. But it should be, close to 1 over time. There's always cases where for a quarter or two, it could be a big difference. It could be 50% or it could be even 20%. But again, like we do for these above 2 ratios here, we want to look at the average over time. And the average over, say, a 1 to 3 year period should be close to 1. It should be, above 90% at the very least. So again, persistently large differences start to raise concerns. We'll take a look at that as an example. And then, of course, earnings variability, right? And that goes without saying. That kind of goes, that's easiest to understand. Are earnings all over the map, or are they growing in one direction? So these are all together, give you a great assessment to check the quality of the earnings of the companies that you own. Everybody should be doing this exercise. You should have, all 3 of these fall into place. And at the very least, you should look at averages, if not for the most recent quarter, but at least over a sort of 1 to 3 year average at the minimum. Operating cash flow and net income should be above 1. Free cash flow to net income should be above 80%. And there should really not be major differences between GAAP and adjusted earnings. That average should be 1 over time. So let's take a look at a couple of case studies here. I've got 2 extreme examples, but I just wanted to show them to highlight how well this does. So we'll take a look at Valiant Pharmaceuticals. If you guys remember, this was all over CNBC and Bloomberg a couple of years back. This was back in 2015 or so, where the stock had just cratered all of a sudden due to various accounting issues. And the ticker symbol, they actually went through a merger or reverse merger, I think. So they rebranded themselves because of all of that negative publicity that they got. So they're now under Bausch Holding Company, BHC, but the same analysis applies to now this company. As well as GE. Remember, GE had a huge cratering of their stock price. So let's see if these quality checks would have helped us prevent a blow up in our portfolios or not. And let's contrast that with 2 members of the Zacks Earnings Certain Portfolio, Point Software and MSCI. MSCI was our most recent addition as of Q1, the rebalance there. So let's take a look. So I'm going to jump into Excel world here and go straight into my handy little spreadsheet. This is great for doing this type of work. And I already have BHC pulled up here. This is my spreadsheet that I do most of my ROIC analysis. And here is that first criteria, which is cash flow to net income ratio. I'm just going to zoom in here so you can see this very clearly. So let's see if we can interpret what this is telling us. So this is net cash from operations, also known as operating cash flow, to net income. This is the ratio over time. Okay. So for years, this was doing well. It was doing fine, nothing wrong with it. Remember, here's our threshold, which is 1. Is comfortably above 1. So again, nothing wrong. It started to fall here. But again, if anything above 1, it really shouldn't give us any concern, even if the trend is down. Companies have, anything above 1, even if it drops, it's not a big deal. There's always going to be volatility in this number. But remember, the magic threshold is 1. So anytime the company starts to fall below 1, it means that whatever earnings that they're reporting is not actually being collected as cash on the balance sheet. So, if it starts to drop below 1, okay, let's say that they started to, present 0.94, that's still not that big of a concern just yet, because remember, like I said, a quarter or two, not a big deal. And especially if it's above, say, 95% or 90%, again, still not a big deal. But now you're starting to see a persistent difference, and it starts to get deeper and deeper. And it actually falls to 50%, below 50% at one point, as of 12/31/2012, as you can see here. So according to my rule, you take, the most recent offense below 1, which was basically 3/31 of 2011, and give it a year. So 3/31/2012 is when I would start to say, hey, we're still below 1. Something doesn't look right here. Okay. And here you can see the other number, which is the difference between GAAP and adjusted. And just look at the vast volatility here. I actually made this, between 0 and 1.5. We don't even care about the negative numbers because that by default means that there's something, majorly wrong happening with the company. But remember, anything below 1 or major differences, apart from 1 starts to call into question the quality of these earnings. So again, you have these massive drops and spikes here. And that starts to get worse and worse, as, the operating cash flow number started to persistently fall below 1 over time. You can see that this number went negative. So if I was an analyst, if I was holding, Valiant stock, I would start to, look at, whether there is a plausible explanation behind this right here. And if there's not, or if it's too hard to figure out, why own it, right? You've got thousands of other companies out there, great companies that are compounding earnings and free cash flow that don't have this problem. Why take on the risk of owning this when it's too hard to figure out the accounting behind it? Because if you just see here, you can just eyeball it and you can see that this number is just very messy. You remember, high quality companies, this number hugs the 1 threshold, quite well. And here we've got this insane volatility. It's just impossible to even explain, what's going on. And then free cash flow, in this case, it's not as, important because, Bausch or Valiant as a company was not very capital intensive to begin with. So the free cash flow was not very different from operating cash flow to begin with. So in this specific case, the free cash flow conversion doesn't really tell us anything different from the cash flow conversion here. So again, these two numbers would have told me that, hey, there's a lot of volatility with GAAP earnings from adjusted. And remember, companies always like to show you the non-GAAP number because it's the better number, right? But on a GAAP basis, if it's not confirming it, maybe for a quarter or two, you can let it go, but not for years and years, right? You can see that there. So what would this have done for you? Let's go into the stock price and look at it, right? So this is Valiant Pharmaceuticals, now known as Bausch Health Companies. And this stock was just a rocket for a long time. You can see that during the offending years, remember, when did it start to fall? When did it stay below 1 for a full year? That was 3/31 of 2012. So I would have exited the stock right around this point right here. Now, you would have had to sit through this and, been able to have to explain to your clients why you sold at a price of, say, 49 per share, and now the stock is at 258. So I would have looked like a big dummy selling the stock when it ended up 5xing from that price. But then look what happened after that. Suddenly everything unraveled and it started to become clear that the earnings that they were showing were not actually real. And that followed a massive cratering of the stock price. It got all the way down to, say, $10 per share. So again, you would have had to, you would have looked like a dummy as the stock 5x'd. But then look what happened here. So again, who had the last laugh, right? It's the operating cash flow, which is king. Cash flow is king, as they say. Well, cash is king, but I would revise that and say cash flow is king. And this gave you a fair warning years in advance. Let's look at the other company. What else did I have in here? GE. Let's look at GE and see how that would have done according to this cash flow analysis here. So I'm going to type in GE and run the refresh here using our Excel plugin tool. This is again available through the Zacks Research System subscription, as well as it's an add-on if you have a subscription to Zacks Advisor tools as well. So this is great for running these types of numbers and building these types of templates in Excel here, which is my favorite thing to do. So as these numbers refresh, we can take a look at exactly how GE looks like, and let's do that here. So GE, again, great numbers. You can see that this number was way above 1. So again, no problems at all with their cash collection here. You can see that on the GAAP to adjusted basis, there's a little bit left to be desired, but you can see that it did pop up above 1. So on average, it was below 1, but above 80% for the most part. So because the cash flow was confirming it, I wouldn't have, really placed too much of a weight on this, because again, as long as cash flow is showing, above, their reported, net income figures, I'd be completely fine with it. But then look what happened as of 2015, but then really in 2016. When did this start to fall below 1? You could start to see this started to deteriorate. But again, as long as it's above 1, I would not have, sold it. But it fell below 1 as of, that was as of Q2 of 2016. So as of Q2 of 2016, I would have started to say, something is up here. So give that a year. So that would be 6/30 of 2017 that I would have, really, started to sell, GE stock somewhere in that range. Look what happened to GE. When did it start to sell off? So remember, I give it a year, right? So it first fell below 1 as of 6/30/2017. So as of 6/30/2016, I should say. So if this was still below 1 as of 6/30/2017, which it was at 0.53, which is horrible, I would have started to sell GE stock. And look what have happened, starting in mid 2017. You had a very fair warning a year in advance to get out of the stock. So by the time they reported Q2 numbers, I would have been exited. So you may not have sold at the top here, but you certainly would have sold, right around, let's just say, the worst case scenario, 192, which was right at, by the end of September of 2017. And look what you would have prevented had you followed, cash flow as opposed to earnings. So again, guys, this is very important, this ratio of free cash flow. And you can see that starting in 2015, GAAP versus adjusted really started to get noisy here. Remember, it was pretty stable for a while. And then they started to get all of these one-time items start to hit. So this would have given you a secondary confirmation that, look, cash flow is deteriorating and we're starting to see, big changes and volatility between GAAP and adjusted non-GAAP earnings here. This is very noisy. So I would have said, hey, this is way too hard for me to figure out. I'm putting this in the too hard pile, as Warren Buffett would say. It's time to get out and get into other companies that may also trade at, similar multiples like GE. Maybe GE was considered a value stock back then at a low multiple. Well, let's find another company that has a similarly low multiple, but also has strong cash flow conversion and free cash flow conversion, and not all this noisiness between GAAP and adjusted earnings. So again, there's thousands of companies out there. Why make a bet on companies that have deteriorating operating cash flow versus net income? So again, that's the big pitch here. This would have prevented 2 high-profile blow-ups. Now, this isn't to say that this will prevent all blow-ups in the portfolio, but this will definitely help save a major headache whenever a company gets into accounting issues. This helps you prevent that because cash flow, it's very hard to fool cash flow when it comes to accounting issues. So let's contrast that with, Point Software, for example. This is one of our companies that we hold in the Earnings Certain Portfolio. We added it just last year to our holdings. How does this look like with regards to cash flow conversion and the adjusted versus GAAP earnings? So let's take a look at that as this number shows up. And we'll just wait a second here as my spreadsheet, populates all the values here. And just look at that. So you can see here that the difference here is that this number, although it has a few periods where it just briefly tucks below 1, on average, you can see the trend line here is well above 1. So again, it looks like the number is taking a dive right now, but overall, it just, it does not persistently stay below 1 ever in the last, 14, 15 years that I have this chart set to. Same thing with free cash flow conversion. In fact, this is even better because even free cash flow conversion is above 1. Remember, the highest quality companies, as I mentioned, score above 80%. And, Checkpoint is above 1, which means that they're just a very capital efficient company. And then if you look over here, look at the difference between what we just saw in the prior 2 examples and this. It's basically just flatline, and that's exactly what you want to see. It's essentially hugging this area of 1. So again, there's always going to be times where there's 1 or 2 quarters, it drops below 1, but again, we want as little noise in this ratio as possible and as close to 1 as possible. And that's about as good as it gets for any company out there. So again, very high quality. We can have very high confidence in the reported earnings that this company gives us. And therefore, we can actually place a lot of confidence in earnings-based analysis like ROIC. Because remember, all analysis is based on earnings. But if earnings has poor quality backing it, if it has poor cash flow backing it, then all of our analysis is moot, right? Because it doesn't have high quality fundamentals backing it. Same thing with MSCI. If I were to show this as an example here, this will show us a very similar situation with regards to cash flow and earnings. So again, this is a metric, this is a routine that everybody should be following. Just want to look for averages over time. Remember, every company has an issue that comes up once a quarter, like once a year, maybe at most twice every few years. So it's not like saying we want, for there never to be an issue, but again, we just don't want issues where it's persistently, below 1, for a very long time. So you can see that this happened at one point, but then, ever since then, for the past, 10 years plus, it's always been above 1 and with very little volatility as well. You can also see the same issue, the same situation here. Not as good as Checkpoint, but still not, anything of concern, that we can, necessarily speak of. So hopefully this was a good example. So this is what we do here at Zacks in the Earnings Certain family of portfolios. And the Zacks Earnings Certain Proxy is the flagship portfolio, which is a list of 75 such high-quality businesses that exhibit such consistency and durability. These are some of the examples of the companies that we own. Very, very high-quality, high earnings consistency companies that we like to look for here. So hopefully this was helpful to everyone. If you have any questions, please do reach out to us. If you are a ZRS client, send us an email at zrs@zacks.com. And if you are an Advisor Tools client, please please do send us an email to zat@zacks.com. All right, thanks everyone, and hope to hear from you and see you again on future webinars. Take care. Bye-bye.